The following podcast was recorded on Thursday, December 15th, 2022, featuring Sam Rines of Arbor Data Science discussing the housing market. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Good morning, Kristen.
We are looking forward to you giving us your perspective on the housing market and what really matters. Sam, we've got a perfect storm brewing in the housing market. You got mortgage rates surging, the U.S. economy is slowing, but let's start with some positives, if there are positives. What's happening with new home sales?
Sure, this is kind of the interesting thing, right? Because it's very similar to the used car market and the new car market, where the new car market's about 1/3 the size of the overall auto market, with used cars making up the vast majority of sales. But new homes do matter, right? It's a signal of, are home builders able to make a profit? How are they doing? Where are the new homes being built? Where are people moving to, et cetera, et cetera? Where's the housing stock really either being built or being maintained in a pretty interesting way? So obviously the South is by far the most important region. And you've actually seen the South hold up rather well here in terms of new home sales. They've fallen off a cliff relative to, the COVID levels, but COVID levels were ridiculous to begin with. So those were unlikely to be maintained over time. But you're pretty much just back to the longer term trend line in the sale of new homes in the South. That's a little different for the West and call it the Midwest. But, overall, sales of new homes very quietly in the Northeast have accelerated recently. So you're beginning to see some divergences, I would say, that are pretty interesting, but also pretty profitable, right? You have home builders that are reporting earnings, and they haven't really been as pessimistic as you would think. It's much different than being a realtor, to be clear. Being a realtor in this type of market is a much different story.
And if we flip next to look at pending home sales, they've been in a free fall since COVID. But the news is not as bright on this side.
No, it is not, because this is where you actually get the existing home stock into a data point, and then it's just absolutely miserable. And at some points, it's worse than, or in some instances, the data is actually worse than it was at the bottom of COVID, which is something that I think is just astounding. But this is where you really have those mortgage rates really beginning to bite, right? It's about turnover, and it's about how many homes you're really going to see that are sold in the overall market relative to, call it, pre-COVID levels and low interest rate levels. That I think is where you're going to see the most pain. It's in the turnover level, not necessarily the price, but in the turnover level, as people really begin to say, do I really want to move with interest rates this high, with home prices this high? You begin to have a slowing of the turnover, not necessarily as much of an effect on the price. I think that's really what you're seeing here, is particularly in areas where home prices move the most, you're seeing those home prices really begin to bite on the overall sale level.
And the next chart we want to take a look at has median days on the market. And can you speak to what's going on in metro areas such as Chicago and Austin?
I have no idea what's going on in Chicago. I mean, that was the most shocking data point, I think, in all of this data was Chicago was on fire, apparently, for days on the market during COVID. And it's basically back to where you would expect it to be, with some seasonality here at the end of the year. It's not necessarily as bad as I was expecting. I mean, I was expecting more like at least a 2012 type level, but nope, we're not there. We're barely back to 2019 levels, and it doesn't really look as bad as I was anticipating. Chicago is shocking. Some of the other areas I think are a little bit more interesting. You have Austin, which was a boom town in Texas. Everybody seemed to want to move to Austin. All the tech guys wanted to move to Austin. Very, very hot market. A lot of selling very expensive homes in California, buying cheaper homes in Austin. And it was a crazy time there. So I think you're seeing that slow down. You're seeing that kind of go back to a normalization of where you would expect it to be, and maybe even a little bit worse, but nowhere near what you would kind of consider to be a crisis level. The shocking thing to me is that the metro areas that we listed here were all above the national level. So there's something there where maybe people aren't necessarily moving as much to cities, and maybe you're seeing a little bit more of a rural movement here where people are snapping up properties outside of cities faster than they are in cities.
And from a bigger picture perspective, Sam, why does this turmoil in the housing market matter?
Yeah, this is where I think it's kind of overlooked. It's not necessarily about the wealth effect, right? It's not necessarily about how much can I take out of my home, do I feel poor, et cetera, et cetera. That's really not the number one aspect of why the housing market matters right now. I mean, sure, wealth effects do have knock-on secondary effects that could rear their ugly heads sometime in 23 or 24, but that is really not the story right now. The story right now is that labor mobility is dramatically declining, and it's declining pretty quickly. And I think it's a good thought experiment to work through where, we have a significant amount of job openings, but people don't seem to be taking them as much. And when people do take a new job and they quit and they switch, they're getting very large pay raises. And part of the reason for that seems to be the housing market. And I think taking a step back here, you call it a worker in Texas, call it a very low cost area, taxes, et cetera, and you get a job offer in Tennessee. And pretty much the same when it comes to taxes and real estate taxes, et cetera. So you're not really having a cost of living adjustment outside of the fact that if you own a home in Houston, for instance, and you sell that home in Houston, you have to go buy a place with a similar school district, with a similar outlook in Tennessee. And you're looking at a very, very large uptick from a 2% mortgage rate to a 6% mortgage rate on a similar home, right? So you're either taking a significant step down in terms of your livelihood, in terms of how good it is, or you're really stepping up the cost of that housing. And so you begin to have workers second guess whether they really want to take that 15, 20% pay raise because that's being eaten up or more simply by the housing cost. So you begin to have labor mobility really pull back, and that creates knock-on effects that could be positive for the FOMC and inflation dynamics as we move forward. But that, to me, is by far the largest effect that the housing market is actually going to have on the real economy. It's not necessarily that people are going to buy fewer stocks or buy less groceries because their home prices went down. It's that they're very unlikely to move in this type of scenario where they're paying, call it a median mortgage of something like $2,500 a month. And in order to have a similar home in a different area, you're looking at $6,500 now just on the interest rate change. So I think there's a lot of dynamics that are pretty important, and that's really where you're going to have the feedback loop come.
In summary today, Sam, what else should we be watching for?
What we should be watching for is those switcher wages. I think that's really what you have to watch in this type of environment. Do they step up, and do you begin to have people say, okay, I will move because I'm getting paid that much more? Or do you continue to have this labor mobility issue that kind of rolls into higher wages, higher wages, higher wages? It's a really interesting secondary effect that I think will complicate the Fed's outlook as we go into 2023.
Sam, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, and have a great week.